Good morning, welcome to end of week Ainsley News. Today we're talking Ray Dalio and how he's warning of increased debt monetisation. Speaking to Bloomberg on the 20th of March, Ray Dalio, head of the world's largest hedge fund, argues that we've entered the latter part of the long-term debt cycle. Here's from him. We see the need to distribute and produce a lot of debt. Where do those checks come from? They come from the government. The government wrote those checks. But the government can't produce money. The central bank can produce money. The central bank had to print a lot of money to lend to the government to do that. And that's called monetisation. Debt monetisation is exactly this process of a central bank enabling the government to essentially borrow money without needing to repay anyone. This is a different scenario to one where central banks purchase the debt of other sovereign governments. Traditionally, central banks have been forbidden by law from holding debt issued by their own government. In fact, the division between a Treasury Department and a central bank was principally to defend against this situation, where a government can freely print money to cover its expenses. Dalio goes on. Central banks are put in a dilemma. Either interest rates will rise a lot or they will have to print money and buy those bonds to hold them down. With national debt now sitting at more than $28 trillion, rising interest rates would lead to unmanageable interest repayments. In 2020, the US made $523 billion in interest repayments on a total of $3.42 trillion in revenue. Faced with higher and higher interest repayments, governments in deficit need to choose between default or inflation. Similar issues are emerging in other countries. The Reserve Bank of Australia is continuing to accelerate purchases of Australian bonds. The Bank of Japan, not satisfied with simply controlling the bond market, also buys ETFs at a rate of $55 billion annually. That's US dollars as well. Investors looking to protect themselves against the coming inflation pretended by Ray Dalio and others are increasingly looking to precious metals. According to 13F filings made to the SEC as of the 12th of February 2021, Dalio's fund Bridgewater Associates held significant positions in gold ETFs and the NYSE. While the GLD position has been scaled back significantly since the previous 13F filing, the combined value of the two positions make gold the second largest holding behind the S&P 500. Bridgewater uses ETFs given the size and regulated space in which they work. Dalio would likely to know better than anyone the dangers of ETFs, and given his view of the economic cycle, it would be an extremely safe bet to assume his personal holdings are in physical rather than ETFs with metals. Dalio has been thinking big and long term for a while now, with widely read articles last year on the fall of the US empire, as with all empires throughout history, and the end of the long-term debt cycle, of which what we've talked about is another symptom. If you haven't read these, we suggest that they are a must-read. And if you have time, click through to his full articles that we've included in our news click through today and read them in full. And as the man himself famously said, if you don't own gold, you know neither history nor economics. Thanks Ray Dalio for today's news and commentary. Remember ainsleyBullion.com.au for all things physical, ainsleywealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own cryptocurrency built and backed by real gold and real silver and stored at Reserve Vault. Enjoy your weekend everyone, and we'll catch you on Monday for more news.